While the world comes out of economic recession due to the pandemic, a lot of things are changing. High inflation, stimulus packages, interest rates. All these words are popping up on the news, but it's hard to figure out how does the whole system work. In this video, we explain all of that and more. Let's start with hyperinflation.
Inflation is the rate that shows how much the price for goods and services rise. A low inflation rate is the norm in most countries around the world. The US inflation rate, for example, in 2019 was 2.3%. In the Eurozone, 1.3%. The American economist Philip Kagan was the first to classify hyperinflation. He stated that the phenomenon happens when a country's inflation rate exceeds 50% per month. There are different reasons this happens. Even though each case is unique, there are common patterns. For example, in most cases, the economy is already weak and there is a shock caused by war, international isolation, or natural disasters. The road to hyperinflation usually comes after a chain of events, and it usually happens as follows. Tax revenues are drastically reduced. The reason can be external factors like war, a sudden change in commodities prices, or country-specific reasons like political transition, bad monetary policies, and even corruption. The government starts printing money. The supply of money pushes inflation up. The rise impacts government revenues. The country experiences a period of high inflation, affecting the government's budget and confidence in its institutions. The government then prints more money and resorts to measures that fail to control inflation. The inflation rate accelerates. The currency value collapses. Inflation explodes. Country experiences hyperinflation. Before the First World War, cases of hyperinflation were rare. Prices rose during the French Revolution and American Civil War, but hyperinflation is mostly a modern phenomenon. The following ranking was created by economists Steve Hanke and Nicholas Cruz. So here we go. Let's see which countries produced the 5 worst cases of hyperinflation in the last 100 years. Number 5. Greece. This is Greece, the country that gave us democracy, philosophers, and probably the world's earliest currency unit, the drachma. It is also the country that experienced the 5th worst case of hyperinflation in history. The worst month was October 1944, when the inflation rate was 13,800%. The New York Times reported that month that $1 was worth 300 million drachmas in the port of Patras. To understand how the situation got that bad, it is important to go back 4 years. The country was occupied by the Axis forces during the Second World War. The new government added to its expenses the support of its army, which had approximately 400,000 soldiers. This expense represented between 1/3 to 3/5 of all the country's expenditures during that time, and notes advanced from the Greek bank paid the bill. When the occupation ended, tax revenues covered only 6% of total expenditures. Another point of instability that contributed to the hyperinflation was the government's policy of paying with gold sovereigns, a British gold coin. This reduced public trust in the economy and added uncertainty to the situation. In 1940, a British gold coin could be exchanged for 1,100 drachma. By December 1944, it could be exchanged for 19.9 trillion drachma. In October 1944, the exiled Greek government returned and implemented plans to curtail inflation. The country continued to be plagued with political instability, internal conflicts, and other difficulties. Post-war Greece was marked by other inflationary periods. The country joined the European Union in 1981 and adopted the euro in 2001. Since then, inflation remains under control. Number 4. Germany. One of the most famous hyperinflation periods in history happened in Germany during the Weimar Republic. Events took a dramatic turn in October 1923, when wholesale prices increased by 29,500%. A loaf of bread in 1922 cost 163 marks. By September 1923, the price had increased to 1.5 billion. In November, it was 200 billion. The situation got so extreme that people were paid out at an hourly basis. Workers rushed to stores to secure food and produce before prices soared again. The prices doubled every 3.7 days on average. It was normal to see people carrying money in wheelbarrows. Restaurants stopped displaying menus. It was pointless. By the time a person finished eating, prices had gone up. Salaries and pensions lost their value fast. A university teacher, an esteemed position in society that came with a respectable salary, could no longer feed his family. A combination of factors led to this nightmare. After the First World War, the country had to shoulder the blame for starting the conflict, pay exorbitant reparations, relinquish control of colonies and territories, and limit the size of its army. All of this would already be a source of destabilization, but there was more. Germany had used bonds to fund the war. The plan was to conquer territories and pay the debt back with the conquered money. But in reality, the new republic was created already with a colossal debt resulting from pre-war bonds. Some economists estimate that it was probably around 175% of the GDP, with no option of a bailout. Quite the opposite. Germany needed to pay reparations to the other countries in hard currency. The government then started printing money to pay its debt and to buy foreign currency. The more it printed, the more the currency tanked and inflation rose. People realized money had lost its value and rushed to spend. This created a vicious circle. In 1914, a dollar was valued at around 4.2 marks. By November 1923, the exchange rate for a single US dollar was 4.2 trillion marks. The situation was stabilized somewhat by a new currency, backed with hard assets in 1924. But by then, millions of middle-class Germans had lost their savings. This period was so traumatic that some people say to this day, it still haunts the public and continues to be an influential factor in the country's debt aversion. Number 3. Yugoslavia. Taking third place on the podium, the bronze medal goes to the Federal Republic of Yugoslavia. In the first month of 1994, the inflation rate rose 313 million%. During this time, you would be able to buy a loaf of bread with a 500 million dinar note. That's it, just one. The situation got so crazy that the cost of a pack of cigarettes in the morning would be the equivalent of one cigarette in the evening. The money value was so high that the government kept introducing new plans to cut the zeros. It didn't work. The situation continued to deteriorate. On January 1st, 1994, the government knocked 9 zeros off the notes with a monetary plan. By the last week of the same month, it had already printed a 10 million dinar note. To understand how this happened, we need to look at the disintegration of the former Socialist Republic of Yugoslavia. From June 1991 to March 1992, Slovenia, Croatia, Macedonia, and Bosnia-Herzegovina declared independence. The remaining two countries, Serbia and Montenegro, formed what was called the Federal Republic of Yugoslavia. The war that followed independence led to international sanctions, which include a trade embargo. The country relied heavily on imports, and the effects of sanctions had a huge impact on the economy. The country had 4 regional central banks, in addition to the official one. All of them, some of them illegally, conducted credit provisions and issued dinar notes without oversight. The newly formed Federal Republic had also 2 outside republics formed by ethnic Serbian majorities, Republika Srpska in Bosnia and Herzegovina and the Republic of Serbian Krajina in Croatia. These 2 republics also went through hyperinflation periods with similar magnitude. The Republika Srpska, for example, had an inflation rate of 297 million% in January 1994. Later in 1994, the government created a new monetary plan with a new currency backed by the German mark. After that, inflation decreased to double-digit levels in annual terms, which persisted for years. Following Montenegro's independence in 2006, the country ceased to exist. Number 2. Zimbabwe. The silver medal goes to the most recent case on our list, Zimbabwe. The African country had the world's second highest inflation and the first of the 21st century in November 2008. The prices increased 79.6 billion%. A bag of sugar cost about 90 billion Zimbabwe dollars, and salaries of unskilled workers were around 200 billion. That was the equivalent of $10 a month. 150 billion Zimbabwean dollars got you 20 eggs, and an average retirement pension paid out 130 billion, which at one point was worth less than $1. To understand what led to this, we need to understand history. After years of fighting between the white regime and black nationalists, Zimbabwe gained independence in 1980. Robert Mugabe emerged as a national leader and was able to consolidate his powers. During his government, he moved toward an authoritarian regime of one-party rule and joined the First Congo War in 1990 and the Second in 1998. In 2000, he promoted the Fast-Track Land Reform Program, which seized white-owned land without any compensation, ignoring a former joint effort with the British government. To make that possible, the central bank started lending directly to new farmers to finance the operations. This led to farmers being replaced by inexperienced, sometimes first-time landowners. Together with the impact of severe droughts, agricultural production and exports declined significantly as a result. The economy stagnated. Food shortages and riots started to take place. The involvement in the wars and accusations of human rights violations raised international criticism, and the country became increasingly isolated. All the uncertainty had a profound effect on the foreign investments, which fell from $400 million in 1998 to $30 million in 2007. Since its independence, there was no year that the government had a balanced budget, and never a surplus. When inflation accelerated, the government tried measures like redenomination of the currency, limiting on money withdrawal, and a price freeze. Hyperinflation followed, and the population moved to foreign currencies, which exacerbated the situation. In 2009, the country created a multi-currency dollarization system that replaced the Zimbabwe dollar. Although it calmed the situation for a while, until today, even after Mugabe's deposition via a coup in 2017, there are still reports that the inflation rate is above 50% in the country. Number 1. Hungary. Hungary experienced after the Second World War what is, to this day, the world record in inflation. The country had an inflation rate of 4.19 quadrillion % in July 1946. Historians recall that the famous Hungarian poet George Faludi was paid 300 billion pego by his publisher. With the money, he was able to buy 1 chicken, 1 liter of olive oil, and a few vegetables at a local Budapest market. During this time, prices were doubling every 15 hours. With such high inflation, people started to rely on the black market. The desperation of the government was so big that it imposed the death penalty for dealings in black market trade in 1945. A note with a face value of 100 quintillion pego was issued. Until today, no banknote with a higher denomination was ever issued. The roots of this nightmare are in the war damage, lack of reserves, reparations, costs of occupation, among other reasons. After the war, the situation was catastrophic. In total, economists estimate that 40% of Hungary's non-human wealth was destroyed. This had a huge effect on the production capacity and put pressure on prices. The Soviets signed the armistice with Hungary and set reparation costs at $300 million, which included the removal of equipment. The Hungarians also had to pay for Soviet troops stationed in the country. According to estimates, Hungary's after-war bill was between $600 and $900 million. With a huge deficit and isolated, Hungary had no other option than printing money. It printed so much that currency circulation passed from 25 billion pego in July 1945 to 1.6 trillion by January 1946, reached 65 quadrillion by May, and 47 septillion pego by July 1946. In 1947, the Hungarian government announced a reform, created a new currency, and stipulated rules such as new central bank regulations to government loans. Prices started falling and went back to normal in the following months.
As we saw, hyperinflation happens when a government loses control of its economy. Next we will see how the system works and how is this possible. Since officially abandoning the gold standard in 1973, the dollar is what economists call fiat money. The word fiat comes from Latin and is often translated as a decree, but in summary, the term means that the money is not backed by a physical asset, like gold or silver. Pretty much every currency in the world is fiat money, and their value fluctuates in relation to each other. Having a currency with no backing makes it easier to control the supply of money. For example, this is helpful in moments of crisis and recession, when the governments resort to measures to inject money and revive the economy. Where there's an upside, there are also downsides. Some see this as the disadvantages of the system. To understand both sides of this problem, let's take a closer look at where the trillions of dollars that are part of Corona relief packages come from. To afford this amount of money, the government needs to increase its debts dramatically. One of the ways of doing that is issuing bonds. Government bonds are debt securities, an instrument used to raise money and support spending obligations. Bonds are basically a document in which a lender like a bank agrees to lend money to the government, and in return, the debt can be repaid at a later date, with interest. Depending on the country the bonds are issued in, they vary on interest rates and dates that need to be repaid. In the case of the United States, the Treasury Department sells the issued bonds during auctions throughout the year. Issuing bonds is a standard procedure. In normal circumstances, there is a market to absorb the bonds without a big fuss. But when we are talking about sudden trillions of dollars, things are not that simple. And the role played by the Federal Reserve, also known as Fed, is what makes things controversial. In theory, the Fed is independent and its main goal is to promote maximum employment, stable prices, and manage long-term interest rates in the United States. But in extraordinary cases, such as the relief packages, the Fed also functions as a buyer, buying most of the government bonds issued. In the first Corona relief package during Donald Trump's presidency, the Fed signaled its willingness to essentially buy an unlimited amount of government debt. The Fed is not allowed to buy bonds directly from the government. It needs to buy on what is called open market operations. It can be bought from the so-called primary dealers. This includes the big banks and brokers like JP Morgan, Goldman Sachs, and others. For example, once the Fed buys the equivalent of $1 trillion in bonds from these institutions, it injects the same amount of money into the bank reserves, facilitates lending, and increases the money supply in circulation. It's direct money being injected into the economy. Money that didn't exist until the Fed bought the bonds. Moreover, the Fed is no ordinary bondholder. By law, it has to pay its profits to the Treasury. At the end of the day, when the Treasury pays interest on bonds, this money generated by bonds that becomes a profit goes back to the government. At the same time that the Fed acts on open market operations, it also cuts its benchmark interest rate, reducing the cost of borrowing. When businesses and people borrow more, it also increases the amount of money in circulation. For the critics, these measures to stimulate the economy are just loopholes in the system, an unofficial way of an endless supply of money, without actually printing it. There is risk to long-term stability and can lead to inflation, devaluation of the dollar, and eventually collapse of the economy. But is the Fed overstimulating the economy with open market operations? To understand the situation, it's possible to look into the Fed's balance sheet, which consists of assets, like bonds, and liabilities owned by the bank. The total amount went from $4.1 trillion in the last week of February 2020 to $7.5 trillion in the first week of February 2021. Not all of these are government bonds, but this number gives us an idea of how much the Fed has been acting during this crisis. Since the dollar is fiat money, there are no limits to issue debt and also no limits for the Fed to act and buy the bonds, supplying the government with more money. And more dollars available can also affect its value. If the United States had a currency backed by something, the Fed would not be able to expand the money supply to such an excessive amount. For example, if the Fed tried to do that while on the gold standard, it would cause the dollar value to fall due to oversupply, compared to its gold parity, and compromise the basis of the system. For the pessimists, this is putting us on a trajectory of crisis, and the collapse is inevitable. So again, in a nutshell, this is how the cycle of collapse would work. Everything starts with the currency backed by a physical asset. In the dollar case, until 1973, it was gold. The precious mineral gave value to currency and created a level of confidence that led to the expansion of commerce and credit. But with the currency attached to gold, there is a limit on how much credit is possible to generate. Plus, the system is affected by the amount of gold mined in the world and very exposed to speculation, as the country needs to always keep currency value in parity with the gold reserves. This limitation led to the idea that gold backing the dollar was not beneficial. The country then leaves the system. The fiat model comes in through a decree. Remember what fiat means. What follows is euphoria. The system is flooded with liquidity. Stimulus packages, increasing spending in many areas, increase in trade. This leads to abuse. Government starts spending more than it should and monetizes even more of its debts to fund its obligations. Slowly, the economic growth starts to decline and confidence starts to fade. Inflation begins rising. All confidence is lost. Hyperinflation follows and the economy collapses. A new government creates a new system with a new currency backed by a physical asset. The cycle begins anew. Critics believe we are at a stage where the government is starting to lose its confidence. Inflation inevitably will start to rise and be followed by hyperinflation and collapse. But is there any truth behind this pessimist view? Well, there isn't a consensus, but it's fair to say that the majority of economists would disagree with the forecast. One of the most critical of these views is Nobel Prize laureate and New York Times columnist Paul Krugman. As proof that pessimism is unfounded, he points to the aftermath of the 2008 financial crisis. From the start of the economic crisis until 2014, the Fed's balance sheet also grew exponentially, more than $4 trillion. And still, inflation stayed low. Krugman believes that the risks aren't greater now. He believes that for the most part, the funds that the Fed injected into the economy simply piled up either in the bank reserves or in cash held by individuals and are not harmful. The Fed's latest bond buying spree is an evolution of what began finding acceptance, considered normal during the 2008 financial crisis. Ben Bernanke, former chair of the Fed during that time, also hit back at the critics. For him, what the Fed was doing wasn't printing money to finance government borrowing, but a temporary measure that would be reversed. Eventually, the Fed sells the bonds it acquired and things go back to normal. Although they believe the practice isn't harmful to the economy long term, it's important to point out the growing level of debt in the United States. According to the Congressional Budget Office, 2020 was the first year since 1946 that the country's debt exceeded the size of the entire economy. The U.S. had a total debt held by the public of $21 trillion, the equivalent of 100.1% of GDP. By 2021, the country is projected to hold $22.4 trillion in debt, 102.3% of GDP. They also project that the debt will represent 107% of GDP by 2031 when it should surpass $35.3 trillion. Does that mean that there is no way out of the crisis and a collapse is about to happen? It's impossible to predict, but generally speaking, there are no signs that the financial market is worried about the growing deficit. The fact is, despite the huge debt, the U.S. government is not financially constrained. It has no problem borrowing money, and borrowing is very cheap, with the 10-year interest rate barely above 1%. Funnily enough, the market sees this as a positive sign, and the country would be able to keep going and borrowing forever under the current circumstances. Moreover, with expected 3.7% GDP growth in the next decade, any debt would tend to melt away as a share of GDP over time. For now, it seems like the full faith and credit of the United States is more than enough for investors. We will have to wait and see for how long. How would the economy be if we still had the gold standard? Would we be better or worse off? Let's take a look. Every once in a while, the gold standard goes back into fashion. The world has moved on from currencies attached to the precious metal for 50 years, but discussions around the topic are more vivid than ever. To understand why going back to the gold standard is still appealing to some people, we need to dive into what are the disadvantages and advantages of the system. The biggest argument pro-gold standard has to do with safety and stability. One can argue that gold retains a stable value to the currency, and this theoretically could reduce the risk of instability and economic crises. With a fixed asset backing the money's value, governments wouldn't be able to raise their debts without first buying more gold. For some people, especially those who worry about hyperinflation and do not trust governments or central banks, the gold standard is a great tool to legally curb government spending and the money supply into society. According to this thought, with the currency attached to limited physical assets like gold, the risks of debt spiraling out of control followed by inflationary periods are smaller, and long-term stability, safety and prosperity would follow. Supporters of the gold standard believe that the system does not allow the government to resort to expansionary measures as it seems fit. Or what critics usually say, simply print more money to finance new debt. And let's be honest, the US debt problem is getting bigger by the day. At the end of 2020, the US government debt held by the public was at more than $21 trillion, a little bit more than the whole GDP. As a comparison, that's much more than what the country owns in gold. The US gold reserves were valued at $11 trillion by the end of 2020. If we look at the historical graph of United States debt since 1966, we can clearly see a path. Look at it here. That's when the country left the gold standard. Now check what happened next. Some believe that if the United States continues down this path, the result will inevitably be a severe crisis in the years to come, and the solution for that might rest on going back to the gold standard. But for some, things are not as simple as gold standard defenders believe. No one disagrees that the US fiscal situation is challenging. But having the currency tied to gold would change some of the most basic fundamentals of the current monetary policy. In the ongoing system, the Federal Reserve can respond to financial crises in many ways. Among many measures, it can lower interest rates during a recession, raise the rates during an inflationary period, or it can buy or sell government bonds and inject money into the economy when necessary. And this flexibility to act according to the situation was very important in the last decade. During the 2008 financial crash or 2020 COVID crisis, the Fed has resorted to expansionary measures. In both cases, if the currency were still pegged to gold, the Fed's actions would be limited, and one can only imagine both the social and economic impacts that might have incurred. On the gold standard system, the focus of any monetary policy would be diverted away from ensuring economic stability to maintaining an exchange rate target. With gold being the most important aspect of the economy, the country's need to keep its reserves intact becomes the focal point of the central banks, more than providing an ideal business scenario, fighting unemployment, or raising productivity. Also, making exchange rate adjustments would be more difficult, and the government would have to resort to alternatives like protectionist measures, higher tariffs, import quotas, or exchange control. The results of this could harm economies around the world and affect global trade. Another negative aspect of the gold standard that is not very often discussed would be environmental damage. Gold is a scarce mineral. Increased demand for gold would mean that mining activity would also increase, very often on indigenous lands around the world. The impacts of this could be devastating. Okay, back to the question of how the economy would look like when we still have the dollar pegged to gold. 3 economists have a possible answer to this question. Through a quantitative method, they calculate how the US economy would have performed if the dollar was still pegged to the gold between 2000 and 2020. The results are not very good for the gold standard advocates. For example, the researchers found that the shocks on gold supply and demand would have a greater negative effect on the economy than any other shocks that have happened, such as an economic crisis. If the gold standard was still in place during this period, we would have an increase in economic volatilities and a deterioration of the household welfare. Basically, the speed at which gold is mined introduces a lot of randomness to monetary policy. The Fed would have to set interest rates to maintain a fixed dollar price of gold, rather than to target inflation as it is today. For example, in moments of crisis, people spend less and investors purchase more gold, a safe haven investment. In this case, the central bank would have to increase the interest rate to make other assets more attractive and control the price of the mineral. If the reverse happens and for some reason there is more gold in the world, the central bank would have to lower the interest rate. In the end, the monetary decision would not be rational or based on facts and estimations, but more a matter of faith, or a belief on what could happen to the gold situation in the world. In summary, an economy based on how much gold is mined around the world would be, let's say, probably more unstable. But is it even reasonable to consider a transition back to gold standard? Well, it depends who you ask. For some, it would be a big mess, but not impossible. For starters, the United States would not be able to go back to the gold standard alone. Due to trade and money supply, it would be very complicated for the US to do this alone. Otherwise, countries that own large chunks of US debt, like China, for example, could just ask for their dollars to be exchanged for gold. In theory, that would not be a problem, but, and that's a big but, if every debt holder does the same, the US probably won't have enough gold in its reserve to pay it all back. Yes, the numbers don't match. So, if it wants to go down this path, the US would have to pump its gold reserves, or the gold price would have to be set so high and the dollar would be so devalued that inflation would follow and trade would possibly crash. That's the scenario that critics of the gold standard believe to happen if an attempt to go back would take place. But defenders do not agree with that. In the end, the gold standard is not as unusual as some people want to believe. It's just a fixed-valued system. According to the IMF, many countries around the world have their currencies somehow linked to an external standard, typically the euro or the dollar. For a country, going back to the gold standard would be more of the same and not that crazy. And if these views were once restricted to the fringes, it really made it to the mainstream in the last years. The Republican Party called for a commission to investigate the viability of going back to the gold standard on the campaign platforms of 2012 and 2016. A bill to establish a commission to look into the feasibility of the gold standard was approved in the House of Representatives in 2015 and 2017, but never managed to get approved in the Senate. Alexander Mooney, a representative from West Virginia, even proposed the full-on return to the gold standard on a bill that never got co-sponsors and never happened. In 2020, when then-President Donald Trump appointed Judy Shelton, a longtime gold standard advocate, to a seat on the Federal Reserve's Board of Governors, everyone thought that Shelton would finally get to the front seat of monetary policymakers. The nomination got stuck in the Senate and never happened, but Shelton's ideas were put under the spotlight. In the past, she had called for a new Bretton Woods conference, referencing the 1944 meeting that established the post-war economic order. To understand exactly what a new Bretton Woods would mean today, we need to go back in time and look into the origins of the first one. The road to Bretton Woods was paved by policies and choices from way before the conference. In 1900, the Gold Standard Act made the policy official in the United States. The gold dollar was then declared the standard unit, and all forms of money issued by the government were to be maintained at parity with it. After the First World War, countries started experimenting, leaving the gold standard and printing more money to save their economies. The United States kept the gold standard. After the crash of 29, investors started trading commodities and currencies looking for safer investments, and the price of gold rose. A hoarding phenomenon spread in the United States, affecting the country's gold reserves. In 1933, U.S. President Franklin Delano Roosevelt issued an executive order forbidding hoarding, and the Gold Reserve Act was signed in 1934. With the forbidding, people were allowed to keep just the equivalent of $100 and everything else needed to be returned to the state. The Gold Reserve Act would lead to the creation of the reserves at Fort Knox in 1936, the legendary U.S. gold depository in Kentucky, where 143 million ounces of gold are kept at the moment. Fast forward to the last year of the Second World War. Representatives of 44 countries gathered in July 1944 in Bretton Woods, a resort place in New Hampshire, to organize what would be the post-war monetary system. It was also in the same event that the ideas of the International Monetary Fund and the World Bank, initially focused only on reconstruction, were forged. The Americans arrived at Bretton Woods in a very strong position. With reserves of 20,000 metric tons of gold, roughly 60% of the world's total, they advocated for fixed conversion rates assured by a dollar tied to gold. The Brits, heavily in debt and broke after the war, were hoping for flexible exchange rates to revive exports. But the Americans feared post-war inflation. In the end, the Americans had their way. After the agreement, the countries were to keep their currencies fixed, but adjustable to the dollar, which was pegged to gold at 35 an ounce. It was only by 1959, however, that the system started operating as agreed in Bretton Woods. Up to this point, countries maintained fixed exchange rates in relation to the dollar by buying their currency in exchange markets when too low or increasing the supply of money when too high. During the 60s, a surplus of dollars caused by foreign aid, military spending due to the Vietnam War, and foreign investment made it almost impossible for the United States to keep the value of the gold at 35. Presidents tried to control the gold price with actions like restrictions on foreign lending. This resulted in the nation's foreign trading position being damaged for the overvalued dollar. In 1971, then-President Richard Nixon announced that the United States would no longer buy gold to maintain the price at $35 and halted the convertibility, which meant that countries could no longer redeem dollars for gold. 2 years later, the gold standard was scrapped altogether. The members of the European Community tied their currencies together and jointly floated against the US dollar. This marked the end of the Bretton Woods Agreement. With Sheldon Farr from the Fed's Board of Governors, a second edition of Bretton Woods might not happen anytime soon. But the idea of going back to gold standard is still around and will not go away. Now we will see if there is a risk of high inflation after the pandemic reshaped the world and monetary policies as we knew before. If you live in a developed country, did not lose your job and were lucky enough to be able to work from home during the pandemic, you are probably sitting on a pile of cash right now. And you're not alone. With restaurants, bars and stores closed, no possibility of travels, and all kinds of limitations that the pandemic brought with it, a lot of people in rich countries saved like never before during the last year. And how these people are planning to spend this saved money will play a big role in what will happen with the world economy in the next few years. Let's take a look at why. While many people lost their jobs and suffered during the COVID pandemic, the fact remains, the reduced opportunities to spend money combined with furlough schemes, unemployment benefits and stimulus checks led to rising household incomes in the wealthier countries during 2020. This created a weird situation, a recession with people accumulating cash at the same time. Research done by the magazine The Economist in 21 developed countries showed that in the first 9 months of 2020 people saved $6 trillion. Had the pandemic not happened, households would have saved $3 trillion. In total, the pandemic meant an excess of $3 trillion saved in 2020. How this money is spent will be a determining factor in shaping the post-pandemic world economy. If this excess money is spent all at once, the first world GDP growth could jump 10% in 2021. This number is so high that not even post-war recovery recorded anything even close. But if that happens, things could not look like a boon, but more like a big bust. This amount of sudden growth rarely comes as a benefit and would be followed by inflation. Worst-case scenario, long-term high inflation. That's why a lot of economists are questioning the size of stimulus packages and central bank actions around the world. Joe Biden's $1.9 trillion package approved last March was also a target of criticism. One of the first to speak out against the size and scope of the stimulus plan was Larry Summers, Treasury Secretary to Bill Clinton and a former top advisor to President Obama. For him, the stimulus package combined with the amount of money that part of the population saved in the last months can create a very unstable scenario for the United States economy with high inflation and eventually even a recession. According to him, there is a chance that macroeconomic stimulus on a scale closer to World War II levels than normal recession levels will set off inflationary pressures of a kind we have not seen in a generation, with consequences for the value of the dollar and financial stability. Stating an example, he calculates the situation of a family of 4 with a pre-tax income of $1,000 per week. Under normal circumstances, this family would take home around $22,000 after taxes in 6 months. If the head of the household loses his or her job due to the pandemic and relies on government benefits stipulated by the Biden package, this family could take home more than $30,000, including regular unemployment insurance, $400 a week special unemployment benefit and tax credits. This is a big difference between the United States and other developed countries. While in most rich countries, wealthier people have accumulated most of the saved money, in the United States the not rich ones were also able to save. A study by J.P. Morgan has found that in December 2020, the poorest Americans' bank balances were around 40% higher compared to the year before. Among wealthier Americans, this number was 30% higher. In contrast, the poorest quarter of European households have been 50% less likely to increase savings as the richest. In Britain, the poorest say they have saved less during the pandemic than before. And in Canada, the poorest did not save at all. That is very important because taking into consideration that rich people traditionally treat saved money as wealth, not as income, the risk of a spending spree and higher demand and supply is limited to Europe and Canada compared to the United States. But demand is not the only thing that will put pressure on prices in the following months. The pandemic created problems that affected supply chains in many different areas. Port backlogs are a reality in many countries, and the rise in demand for electronic products created a shortage of semiconductors that has impacted many sectors, including car manufacturers and tech producers. On top of that, weather conditions in some parts of the world also disrupted supply chains, like the extreme cold in Texas in March 2020. And let's not forget a ship that blocked the Suez Canal for a week in March. According to Bloomberg, due to high demand and supply chain problems, as of May 2021, The world is also low on copper, iron ore and steel, corn, coffee, wheat and soybeans, lumber, plastic and cardboard for packaging. All of this adds worries about the future state of the economy. Usually, when a country is dealing with inflationary pressures, the central banks can act in a very simple way. When there are indications of tendencies toward higher prices and a stimulated economy, the central bank raises the interest rates to make access to money more expensive and therefore reduce economic activity. This usually leads to lower inflation. When the economy is slowing down, it does the opposite, reducing the interest rates and flooding the market with cheap money. In this case, a little bit higher inflation is usually registered. It has been like this for a while, and in general, in the last decade, if we look at central government targets, lower inflation has been a bigger problem than higher inflation. But as the economies start to reopen, some fear that the circumstances of excess money combined with supply chain disruptions might make the work of central banks controlling inflation through interest rates much harder. In the end, there is no way to escape inflation when there is too much money chasing too few goods. And signs of higher prices are starting to be everywhere. The United Nations estimation of global food costs rose for a 10th month in March 2021 to the highest since 2014. U.S. consumer spending on goods was up nearly 10% in January from a year earlier, according to the Commerce Department. Demand for new houses in the United States is so high that in March 2021 almost half of new listings are selling within a week of hitting the market, according to Redfin, a real estate brokerage. Annual price growth reached 17%. This is the highest growth since 2012. The Fed already announced that the U.S. economy should recover faster than previously projected. And the recovery of global output returned to pre-lockdown levels by December 2020. This was much faster than in the aftermath of the financial crisis in 2008. Right now, it's pretty clear that inflationary pressures are growing, but it is still not clear to what extent, for how long, and how the Fed will react to it. These variants are decisive to the state of a post-pandemic world. Greg Mankiw, a Harvard economist, considers that inflation will become a problem only if consumer prices grow more than 3% a year for the next 5 years. For Jason Furman, a former Obama administration economic advisor, if consumer prices stay between 2.5 and 3.5% higher per year, it would already create problems. Janet Yellen, the Treasury Secretary, has said that she doesn't see these signs as a problem. She hit back at critics in February 2021, asserting that the United States has the necessary tools to deal with inflation should the need arise. Those tools are also a source of worry. If they drastically raise interest rates to control inflation, for example, this could set off a new recession domestically and affect the whole world. Past examples are still fresh. Remember the Great Inflation of the 70s? Interest rates were raised to 20%, unemployment skyrocketed, and a recession followed. Higher interest rates in the United States could also mean difficulties for developing countries. A hike in rates combined with a strong dollar will probably mean an outflow of capital from emerging markets, followed by recessions and difficult times. If it happens, this could be a big disaster for economies already struggling to recover from the pandemic fallout. The reality is, as economies slowly reopen and people spend their saved money in stimulus checks, the demand for certain goods and services will exceed supply and generate higher prices. Right now, most economists seem to agree on that. But the long-term effects of this phenomenon depend on how long it will last and how the United States will react. And depending on what happens, the consequences will be felt everywhere. And the world economy, so used to low inflation controlled by central banks' interest rates, might never be the same again. And now we will explain why all the recent stimulus packages might have a negative impact on the economy in a long run. Take a look at this graph. The blue line shows the amount of bankruptcies within the European Union. This is the first half of 2020. The reason behind the drop is a problem that may haunt governments for years to come. During a period of lockdown and recession, fewer companies failed. This was a result of a combination of furlough schemes to reduce wage bills, state-backed loans to provide liquidity, and laws to avoid bankruptcies. As the numbers show, it saved a lot of companies. But some say surviving in cheap debt and government aid is not a healthy option. The result could end up being a whole new group of what economists call zombie companies. And just like in the zombie movies, they are dead, but feed off the living. Should we be worried? And to what extent? Let's look into it. By definition, a zombie company earns just enough money to continue operating while being unable to pay off its debt. Basically, a firm that can't generate enough business to operate without financial assistance. They are companies that usually exist on cheap money and government aid. And although they always existed, the corona pandemic is creating a greater risk of extra zombification. If we look at the numbers, there are clear signs that cheap money combined with government actions aimed at saving economies are creating a very fertile scenario that can lead to the rise of zombies. In 2020, bankruptcies fell 40% in France and Great Britain. Looking at the European Union as a whole, bankruptcies were down 25% on average. According to a European Commission note, without help and new loans, almost a quarter of EU companies would have liquidity problems by the end of 2020, and the National Bureau of Economic Research, an American organization, found out that without state-backed loans and subsidized payrolls, European business failures would have almost doubled in 2020 instead. At the same time, central banks have eased monetary policies all around the world, injecting a lot of cheap money into the economies. The central banks of the world's 10 biggest economies expanded their balance sheets with a near $7.5 trillion buying public and private debt. Outside of the big league, the central banks of 20 emerging market countries deployed asset purchases for the first time. In total, the fiscal policy response to the pandemic can be estimated at around $12 trillion. In the EU, almost 2.3 trillion euros in national liquidity support measures helped stave off a rise in insolvencies. A big part of this money was used to provide companies with cheap loans, or in other words, more debt. The corporate debt around the world escalated dramatically during 2020. In first world countries alone, corporate debt went from 91% of GDP in 2019 to 102% at the end of September 2020. And keep in mind that the 91% from 2019 was already a record. So it's safe to say companies are in debt like never before. In the EU, borrowing surged with France, Italy and Spain topping the list. But you are probably thinking that saving companies from bankruptcy during a pandemic makes sense, right? Well, you're not wrong, but these measures come at a risk. An economy without growth combined with easy credit is the perfect scenario for a company's zombification. After all the support is used up, there is a chance companies will survive as zombies, able only to keep repaying their debt, unable to move into profitability. And in the long run, this can lead to long-term stagnation, lower productivity, unemployment, and many bad after effects. Researchers point out that zombified companies invest and innovate less, impacting the entire economy. And there is the contagion. In countries with too many zombie firms, healthy companies also invest less. According to a report by the Bank for International Settlements, a 1% rise in the number of zombie companies translates into a 1 percentage point decline in capital spending by non-zombies companies. To better understand the effects, we have to look into some examples from the past. Zombie companies are not a result of the COVID pandemic. They are very well-known economic phenomena that have impacted many countries. The term was first coined in 1987 to describe U.S. banks kept alive by government bailouts. But the term gained popularity in the 90s, especially in Japan. During this time, companies that weren't profitable were the main reason for the so-called Japanese lost decade. From 1990 to 2000, Japan had low economic growth while banks, unwilling to recognize losses, kept credit flowing to insolvent borrowers. In the early 2000s, around 30% of Japanese public companies in construction, real estate, manufacturing, retail and services were unprofitable, kept alive solely by bank loans. The economy suffered from a dormant labor market and low productivity. GDP grew only 1.14% annually, below other industrialized nations. But although Japan's lost decade popularized the term, the zombie phenomenon was known beyond its borders. The share of zombie companies in Western countries increased from 1% to 12% between 1990 and 2016. But what is the solution? Should governments just let the business fail and move on? Well, according to specialists, extreme situations, like the coronavirus pandemic, require help in form of cheap loans and furlough schemes. But governments do need to know when to stop, otherwise, the good intentions might turn out to be counterproductive. And the EU seems to be aware of that. A European Commission note from February 2021 stated that almost half of all firms that would have had liquidity problems during 2020 because of the pandemic were already at a high risk of default before the crisis. According to the paper, due to the pandemic, the companies burnt not only through their own cash reserves and money provided by government funding, but also increased the amount of bank loans. The challenge now is to figure out which companies need help to survive an economy in lockdown, and later can continue generating revenues, profits and jobs once things start getting better, and which companies are simply using this money to prolong their already moribund business. To do that, one of the solutions propagated by specialists is that countries should stop supporting companies, but focus on the workers. In summary, generous unemployment benefits would be more helpful than a continuous flow of cheap loans with no end in sight. Interest rates should also be raised eventually, as loans with artificially low interest rates also contribute to the zombification of these companies. And some also believe that governments should create ways of allowing companies to fail quickly. Instead of trying to save what in some cases is an inevitable situation, companies should be able to quickly and efficiently declare their insolvency, and in some cases be offered alternatives to possibly recapitalize or redirect their assets and employees. Governments and central banks should be looking into how to do that, instead of trying to save the unsalvageable. The European Union doesn't seem to be ready to take these steps yet. In the last 2 weeks of March 2021, the central banks of the EU have bought an average of €20 billion worth of debt securities per week, mainly to keep financing conditions of governments and companies. Christine Lagarde, president of the European Central Bank, said that the pandemic bond program is set to run until March 2022 and can be extended if the bank deems it necessary. Until then, cheap money will still be available to companies. The EU challenge is to figure out a way to keep loan options open to viable companies, not to every company. Saving economies from a deadly pandemic that has the world in its grip is one thing. Providing cheap money and contributing to the zombification is something else. Knowing the limits seems to be the most important thing. Otherwise, the zombies might rise, and just like in a horror film, they will feed off the living, slowing down any chance of recovering. So that's it for this video. Since you made it to the end, click around and watch more. We hope you liked our video and subscribe to our channel.